So sure, the tech companies absolutely fell off of a cliff on today's session. The Q's down a whopping 1.78% up there. But believe it or not, so far this week there have actually been some pretty bullish improvements taking place behind the scenes. That's what I'm here to talk about in today's episode of the Midweek Market Update. We'll of course be looking at both sides of the coin, that way we can build an actionable game plan into the Thursday and Friday session. But as always, if you're new here, check out the links listed down below in the description, hit the thumbs up button and subscribe if you haven't done so already. And stay tuned until the end of today's show. I've got 4 additional trade ideas to share with you that you won't want to miss. With that said, we're going to kick things off on the SPY daily time frame chart. Not much has really changed over the past 3 trading days. We've really gone sideways, building out a 3-bar balance. We'll talk about that on the hourly in just a moment, but for now, on the daily chart, what's going on with trend? It's really unchanged, right? We have lows, higher lows, higher lows, highs, higher highs, higher highs, and we're sitting on higher highs. So daily trend is up, we're sitting on a higher high, and therefore it's totally reasonable that the daily chart sees a pullback to search for a higher low. And we'll build the case on the hourly for 422 in just a moment, but let's take into consideration some upside targets first while we can still see them on the daily time frame. If this balance range, or we could think of it as a bull flag, breaks in the upward direction, the top of range is 429.25, the next overhead target 431.75, and then beyond that we have 437. Now bear with me, 437 seems like it's miles and miles away, but if we take a measured move from this flag, it's really right kind of on point with the measured move. That might be a little bit of a stretch. Maybe we're just shy of it at like 436, but the point stands that the upper edge of the weekly expected move is kind of in alignment with being an undercut of the measured move from the pattern that's at play. That's the main point. I'm not advocating that we go here, I'm just pointing out that structurally speaking, if we remain in flag consolidation, then, it's kind of on the table as somewhere within the realm of possibility. But let's be a little bit more realistic about this setup. Today's daily bar certainly is not encouraging for upside. So let's move on down to the hourly time frame chart and get more granular here. First and foremost, let's think about the psychology of the first hourly bar from today's session. Technically, in that upper wick, we breached the Tuesday highs, we breached the highs from the Monday session, and we're looking at a move over that 429.25 level that we were just discussing. Now, in that same hourly bar, we reverse all of it, close underneath the opening print, we downtrend for the remainder of the day, and close pretty weak down at the lows of support here, 426.50. So if there's evidence to say that there's going to be a pullback, the failure of the buyers up here at the top of the range certainly strikes me as a bearish data point, right? So how do we actually get involved in this, and how do we look for that 422 pullback? Well, first and foremost, if you're an aggressive bear, you could certainly look to take the break of that area, but I would say because we're in an uptrend, you probably want a little bit more confirmation before doing so. So a lower high underneath is certainly tradable for some downside outcomes. That way you can place your stop just above, and we'll look for the gap to close 424, closes down to 422.90. Beyond that, we have the lower edge of the weekly expected move at 422.30, and then the prior breakout from the equal high back here at 422 even. Now, that's all fine and dandy. We have some structure that's back here, but it gets better than that. If we throw on the anchored view app, and we talked about this in the Saturday video, right? It's confluence of support now. It did exactly as we pointed out. It creeped up, and now it's providing confluence of support. So if we do see this breakdown, that's fine. You can short it for this range in the downward direction. But when and if we get to 422, I would promptly change my tone and start thinking about how we can get involved in reversals as we potentially find a daily higher low, right? So what happens there? You're looking for hammer candles, and these are not drawn to scale. They're just illustrations, right? Double bottoms, inverted head and shoulders, any reversal pattern really goes at 422. But wait, there's more, right? We also talked about this. If we come in with the Fibonacci's from the low of that same day up to the top, right? Where's your 38.2 Fibonacci? It's at a gap close, right? So anywhere in this zone, you should be very open-minded to the potential for a reversal when and if we find a daily higher low, right? So that's what we have to the downside, and that's how we're going to get involved. Lower high underneath, we can trade some short outcomes down here, right? Now, one thing to also consider is that because we're in a daily uptrend, if that fails and we see ourselves a look below and fail, perhaps all that we require to repair this level, because it is a weak level, look at how precise those touches are, right? If all it requires is a quick stop run to grab that liquidity, and then we rotate back above 426.50, all it takes is a higher low, and now we have a look below and fail. Just like we had a look above and fail in the upper wick of this morning's session, we can have the same thing take place in the downward direction, and I would look to trade that if we get a higher low back above 426.50. The target would be the top of the range at 429.25. So we've covered up and downside scenarios. Let's take a look at some supporting evidence. Exhibit A is always the market internals. If you're not familiar with this screen, check out the tutorial in the top right-hand corner. Let's keep it very, very simple. As the market pulled back on today's session, if new money sellers and aggressive sellers were getting involved to kick off that pullback, is this what the dashboard would look like? And I have to answer that with an objective no. If we look at the volume flows, technically they're inflows on the week, and don't get me wrong, this is not a bullish call. These are certainly not significant volume inflows, but they're not bearish, is the point. Right? So significance 500 million, we're at 218 million. In terms of the advanced decline line, we never get in trend lower zone on the Monday session, and on today's session, where arguably the biggest or easiest downtrend to identify was produced, we actually touched trend higher zone. Now, once again, I'm not making the call that this is picture perfect. In a better world, it would have, stayed up here. Not making a bullish call, just saying that big new money sellers are not getting active based on what we can see there either. If we look at the cumulative tick, flat on Monday, flat on today's session, right? That's really noteworthy that this didn't even build out negative, right? So what does that tell you? That breadth is actually improving across the S&P 500. Right? As our tech cohort, all the big names, the heavy weighted names that we see on the list up here, as those pulled back aggressively across the entire S&P 500, really this is the NYSE, right? The New York Stock Exchange, there was actually not enough downward activity to produce a negative impression out of the cumulative tick. Let that one sink in, right? There's the Elon Musk meme. Let that sink in. Right? So overall, this does strike me that we're getting mild pullback so far, and it's not anything to be concerned with yet. We're looking for support at SPY 422. Exhibit B is always going to be the market profile. If you're not familiar with this one, check out the tutorial in the top right-hand corner. I think that this screen really sort of reaffirms the belief that the bottom of range will break down, and the reason being is that we have value area which migrated lower with price, point of control which migrated lower with price, and the worst indication of them all is the extremely poor low at the bottom of today's range, right? That is the improper end of the auction. In theory, we need some excess there, and if that ushers in the breakdown of 426.50 on your SPY, the equivalent number on the futures here is going to be underneath 42.69, call it 42.70. If we're underneath that, we look left. It's not that these are single prints, but there's definitely thin structure there compared to strong volume support, and then of course we're dealing with the gap close. In the ES, the gap close is closer to 42.40. We'll talk about that in the pre-market prep tomorrow, but once again, value lower, point of control lower, poor low. Those are the main takeaways here. Jumping back on over to the platform to evaluate the weekly performance of our sectors shows us that utilities lead the pack here, up 1.88%. Pretty concerning considering they are D for defensive, not that great. Also real estate and materials, lightweight sectors up here at the top of the list. At the bottom of the list, we see the XLK tech sector, heaviest weighted component of the S&P, most risk on component, down a whopping 2.03%. Kind of a red flag. XLV healthcare, second heaviest weighted component. XLP consumer staples, I'll give a little bit of credit there. That is D for defensive technically. But before we get all wrapped up in the bad posture, let me pose a question to you. Would you prefer to see leadership this way as the market is going sideways and cooling off, or would you prefer to see leadership this way as the market is breaking and continuing to make a move in the upward direction? Now, I don't know about you, but this certainly continues to feel more like rotation as opposed to a rally that's running out of steam, right? The lighter weight risk off sectors are playing catch up as the heavier weight risk on sectors are going sideways or pulling back, allowing for healthy rotations in the market. So at first glance, it seems bad, but if we take another step further, it's not really the end of the world. Remember that at some point, the lightweight sectors, the D for defensive sectors, they do need to technically move in the upward direction. We can't have them going down all the time just because they're D for defensive. So utilities is up first. Any leadership issues here? Is it taking out, big swing highs? The answer is simply no. It's making a little bit of a rebound off of an equal low. It's not the end of the world. So rotation. If we look at the XLRE, what's going on over here? Certainly threatening a break at the top of the range after a very impressive day on today's session, over 37.50. From the wealth effect perspective, I would have to imagine brings in or starts to entice more money into the financial system. So we can talk about inflation and the implications there. That's a totally different topic for a different time. But in terms of net capital flow in the financial system, higher home prices, higher asset values does tend to support higher equity prices as well in the stock market, right? So XLB, what's going on with materials? If we take a look at this, is it exhibiting a break of this? No. Is it definitely getting in gear up and over a trend line? Yes. Once again, just because it's a lightweight sector, just because it's D for defensive, we don't want it going down forever. At some point, it needs to make a stand, right? And it's not really threatening leadership at this point in time. If we look at the XLI, it's really just still stuck in a sideways range. It's made a very impressive move off the lows to the top of the range. Because we have a move from wall to wall, as we call it, I would definitely expect some sort of pullback up here. And maybe as that cools off, we see some more rotation back into the heavyweight tech sectors. And we'll get to that in just a moment. XLE, same idea as utilities, basically. After an equal low, we're rebounding. We're getting a little bit of a move in the upward direction, but at best, we have a neutral trend. It's not really a big new uptrend. It's not threatening leadership. Not a cause for concern. Still more rotation. If we look at the XLF, this one is worth noting because it is a heavier weight risk-on sector, and it's been the laggard of the risk-on cohort for quite some time. If you want to think of this as a double bottom, we are technically over the neckline, and we did find support at that neckline, 32.85 on today's session low. So as long as we hold up above that going forward, this does strike me as a bullish data point. We want to get to the 200 SMA, and we want to breach that because if we look left, there's thin structure, and a retracement through the banking crisis breakdown is really, really constructive for the S&P 500. We know that the tech sector, we know that discretionary, we know that communications, those sectors have already done the work. If financials can follow suit and we can see a move over 33.65, that continues to push this rally in the upward direction in my estimation. Higher low pullbacks at best want to support at the top of the gap and daily 50 SMA. 32.40 is your number. XLY, we just talked about, it's done the work. It's put in the effort. It broke that 148 stubborn level. Big move in the upward direction. Mild pullback off of a higher high. It could close the gap and reverse off of 153.75. Not concerning from a trend perspective. Everything's fine and dandy here. In terms of implications for the end of the week, yeah, large red-bodied bar, I would watch out for continued pullback, and that does support the idea that we're looking for the deeper SPY pullback as well underneath SPY 426.50. XLK, what about this one, right? And we'll see this in the QQQ as well. Breaking the bottom of the flag. We have thin structure off to our left. Could it continue to pull back into the end of this week? Absolutely 100% yes. Is it going to jeopardize the trend? The answer to that question is just clearly no. If we come in with a support trend line, right, technically trend is way down here. I'm not calling for a pullback to close the gap, but we could technically do it and be finding a higher low based on that trend line that I've just sketched in. So bearish pressure into the end of the week? Yes. Is it the end of the world? No. Let's take a look at the XLV. What's going on over here? This one is slightly more concerning, just because of the way it's interacting with this 129.50. Remember that we were looking for, and the concern at first was the lower high underneath. So, okay, phew, no big deal. We break above. Now we're just kind of looking for the higher low above and watch for this thing to neutralize out. It's back underneath. The worst thing that this could possibly do is a full retracement back down to the equal lows, and because this is the second heaviest weighted sector, that would put some serious bearish drag on the S&Ps. So that's something that I'm definitely keeping in the back of my mind. I really want to see how it resolves this area. We don't have a hammer. We don't have a double bottom. We don't have anything constructive yet, but watching the XLV very closely to determine if we can use this zone as a higher low. If so, that is constructive and your market probably hangs in there. If it starts falling off of a cliff again and this move starts to continue, much more of a red flag. Next up, we've got the XLP. What's going on with staples? Definitely bearish, definitely putting in bear flag consolidation, sitting on the lows. Just like the S&P, we have all these equal lows. Could use some repair there at 72.35. When and if we sweep it, look for 71.60. This is D for defensive, so if something is going to continue to break down, this is where we want to see that breakdown. Not really a red flag. Let's take a look at the XLC communications, then we'll get on over to that ratio grid. Higher high, pulling back. Could find support here at 62.15. I would be watching that like a hawk. This is a red bearish engulfing hammer, or excuse me, bearish engulfing bar in general. It's certainly not a hammer. It's an engulfing bar. That does imply that there can be some more downside here, but once again, from a trend perspective, trend is strong. We're seeing rotation. When and if we come into 62.15, we'll look for reversals. Even if we go beyond that, I would start to say that a line in the sand, if you think about weekly higher lows can be found here in this zone 60.75 down to 60 even. You're getting lows, higher lows on the weekly. Again, intraday, intra-week, bearish pressure, but overall, the structure is still healthy. We still are dealing with a market that's being driven primarily by the risk-on sectors. Here's the ratio grid. If you're not familiar with this screen, check out the tutorial in the top right-hand corner on how to set this one up. For the most part, the top four are the heavyweight sectors for our S&P 500. The XLK is the heaviest weight risk-on sector, and it's pulling back mildly, but notice that it's above an upward sloping 50 SMA. This is more indicative of that rotation theory we were just discussing. XLV is trying to go sideways. We want to see that structural chart go sideways as well, and that will be okay. Remember that this is technically D for defensive. We don't want to outperforming or really looking better than the XLK, for example. XLF trying to find a rounded bottom here, but still underneath a downward sloping 50 SMA. It's really got to breach that to start looking more constructive. XLY speaks for itself. Big new higher high, tons of relative strength. That is a risk on look. Closest tie to the XLK, of course, is the XLC communications, still in a glaring uptrend over an upward sloping 50 50 SMA. The bottom four are not only lightweight, but they are definitively risk off. XLP staples are falling off of a cliff. Then we're starting to see a little bit of curling action out of utilities, energy, and real estate as well. But notice it's still far below a descending 50 SMA, still underneath a descending 50 SMA. Same thing here in real estate. And as we know, that has much more to do with the wealth effect anyhow. If we take a look at something like the XLY over the XLP for growth versus value, continues to just absolutely skyrocket in the upward direction, producing a new higher high. So if this does start to pull back, it's not the end of the world from a trend perspective. We have lows, higher lows, we have highs. Now higher highs, if it pulls back, ideally we just find a higher low somewhere in the ratio above 2, and we are good to go from the risk on look. As always, here's just the generic reminder that as we move out of S&P price action itself and into intermarket relationships, everything that we're about to assess is one data point in the web of analysis that we spin, and we always need to look for a price action setup itself in the SPY or the SPX, ES, whatever, before taking action on a given trade, right? So no matter how divergent a relationship is, you need a price action setup. So with that out of the way, the dollar is certainly producing still bull flag consolidation above a prior inflection point level of interest here at 103.50. If this breaches the flag in the upward direction, I would have to imagine it coincides quite nicely with a break of the bottom of the range, SPY 426.50, and we do look for that daily higher low pullback that we've been building the case for in today's episode. Taking a look at something like the gold contract over at /GC, it confirms that idea, right? Because gold is still rejecting with lower highs underneath the $2,000 price point. If we take a look at something like the TNX for our 10-year interest rate and zoom in, we've definitely got ourselves a break, retest, and higher low. But the one question that you have to consider is, okay, if the Fed's going to pause rates, and there's a whole ton of economic data we're going to get next week, we'll take a look at the calendar in just a second. If this produces a double top, please don't get bullish on tech just because it produces a double top. It needs to break down back into the range and be underneath 36.4 for it to be more of an upward force for your XLK, right? So if we think about this in tandem, it's no surprise that when the market was breaking out here, rates were actually moving lower. And now as the market's consolidating and pulling back and tech is kind of lagging, as we can see, down 2.03% on the week, rates have actually been moving higher. So keep a very close eye on this relationship. It seems to be incredibly important at this point in time. Let's take a look at the fundamental data. The Fed tracker tool is still showing us that it's a strong probability that we do get a pause in the next meeting, but we're coming in with diminished odds overall. And I think this comes from the lack of confidence that the public has in the Fed right now, or at least the bond market has in the Fed right now. Powell is deciding not to use the term pause. They've been very explicit that they're calling this a skip right now. And I think that they're just going to be data dependent. I don't even think that the Fed knows whether or not they're going to raise or pause in the next meeting here. They're just trying to keep open the backdoor possibility of one more hike and then aggressive cuts into the back half of 2023, in my estimation, with their language by not using that term pause. If we look at the fundamental data that came out earlier this week, that was ISM Services PMI. Services inflation is what needs to tick lower, and so far, we did come in underneath the forecast, but above 50, which is indicative of that soft landing narrative. And so far, all of the data we've seen, jobs reports, and even CPI last month being sort of flat. It wasn't a great report, I will fully admit that, but it was flat, right? It didn't tick back higher. It's more indicative of that soft landing. But if early next week, if we just take a look here, we've got a loaded week, right? Tuesday, 8:30, CPI, core CPI, Wednesday, 8:30, core PPI, and then Powell has to make a decision, right, by that afternoon at 2 p.m. So if they're going to be data dependent, I think you see massive fluctuations out of the Fed tracker tool. And once again, if the soft landing narrative is going to hold up, this needs to come in at or below expectations for inflation. Otherwise, a resurgence of inflation is a massive big red flag. Market probably panics. Risk appetite charts, TLT flight to safety. The answer is absolutely not. This is pretty bullish for the chart down below, or at least supportive of the idea that we're in a risk-on environment. If we look at something like the HYG for junk bonds, of course, we're still in that big bearish divergence, but you have to at least acknowledge that we have lows, higher lows, opportunity for higher lows here. And in equities, we've got lows, higher lows, and we're looking for that higher low. So if anything, this is more supportive of the breakdown of 426.50 SPY, looking for the higher low. As we start looking at breadth, this is really where market improvements have been made. Notice the strong move in new highs versus lows above the zero line. That is certainly more supportive of a healthy market, which is playing catch up to the few leaders that really started the rally in the first place. We could say similar things if we take a look at the SPX A200R stocks trading above the 200 SMA in the S&P 500 weekly timeframe chart here, now recapturing the 50% mark. And the best one of them all is the constructive look that we're starting to get. We're not all the way there, but it's definitely a big improvement out of the SPX A50R. This is now a daily time frame chart. Now recall that we really want to be above the top of this range, but there was a massive divergence as of the close last week with the lows down here as the breakout started to unfold. During the last 3 days of balance, breadth has improved and we've actually recaptured the 50% mark and we're sitting at the equal highs. Now we need to get the break of that level and see this marry up to be much more confident in the market and equities down below. If we take a look at the RSP, it continues to show us some divergence as well. Just notice that we are yet to break this. That, of course, is the equivalent of back here, but some big steps in the right direction, right? Let's not get things twisted here. Are we moving in the right direction or the wrong direction? This here is certainly a move in the right direction. And if we take a look at the last one here, which is the Dow Transports versus the Industrials, notice that things are still in sync. We have a little bull flag that's building in Industrials. If that breaks out, perhaps this makes the move here as well after the big bullish bar on today's session. This is really not all that far out of whack, and there's no big divergence happening in transports versus industrials, supporting the idea that the market's getting healthier, it's not getting unhealthier. VIX volatility just made the lowest low that we've seen since the you-know-what sickness way back when, and anyone who's telling you that the market must crash because the VIX is, quote, too low, simply does not understand how this instrument works. If we take a look at something like the VVIX, the volatility of the volatility index, we know that we've broken this trend line, and we're not yet at the complacency zone down towards 75. So could people be caught offsides? Absolutely. It's technically a possibility, but the market will not crash just because the VIX is sitting down at really extremely depressed reads compared to what we've seen over the past year and a half in primarily 2022, right? Outside of 2022, the VIX has historically spent times in these low zones. If we look at volatility futures, stronger contango, still in contango on the 9 versus 30 day for all the non-believers based on 0 DTE, and we can still look at the skew. The skew did produce a continued, I should say equal high, higher high here on the weekly time frame chart. So we're definitely sitting at historically high levels, but just remember, this is people pricing in sort of a black swan event. This speaks to tail risk 30-day plus options in your SPY puts and just the chain there in general. Those black swans don't necessarily have to come true. So the highs here are not nearly as important as the lows when bears are capitulating. QQQ Nasdaq 100, nasty, solid red-bodied bar on today's session, but is it the end of the world is the question that I would pose to you, and I would have to answer that with no. The daily trend is still up with daily higher lows in place and the possibility for them to hold, as well as big time higher highs being produced. So daily trend is up. We're still searching for that higher low. There's no real reason to panic just yet. If we scrunch this chart way out and take a trend line, for example, from here to here, I'm not saying that the market must pull back all the way to the trend line, but just as a very easy visual, on the weekly time frame chart, you can certainly afford a higher low here. So the context overall is still bullish, even though we have a nasty breakdown on today's session. Now, into the remainder of this week, it's not to say that the market can't continue in the downward direction. We just want to be very tactical about our short entries. So note also, we are sitting right on the lower edge of the weekly expected move and this key support zone at 346.75. Let's go to the hourly time frame chart and see why that's so critical. So I'll always give credit where credit is due. Fantastic. We got the head and shoulders, lower high, rejection in the first hourly bar, just like the S&P, and it was lower after that. The fact that the Qs broke down through the bottom of the range here at 352.75 is impressive, especially on that momentum that's there. So if we start to find a daily higher low at 349, and again, all the same ideas that we talked about on the SPY, these are just illustrations, but you get the idea. These things hold. These reversal patterns hold at 349, and as we start to rotate higher, the target should just be 352.75. Now, the key issue really arises where if this turns into a larger head and shoulders and we truly get like a daily lower high off of this level, now we're dealing with something that looks like this, your line in the sand pullback level is now in jeopardy at 346.75. We know this to be a very poor level. It's a poor low on the market profile. It's a mechanical level on the market profile. If that breaks, we know that we have thin structure off to the left. So the bear case is a little bit more relevant, at least in terms of how we trade this on the QQQ, given the structure that's already emerged. Once again, we're looking for support here, then a lower high perhaps underneath the 352.75 if a deeper pullback is going to unfold. The bulls only have something going on if this holds and we are able to get here and breach that with a higher low above for the more constructive resumption of the overall daily uptrend. We can once again build the case for this level if we just throw on the anchored view app from the previous Thursday when that gap up took place. We're kind of at that zone of support. Don't get me wrong, we're already technically underneath it. So treat this as a zone. We're coming into this confluence of support. Same thing holds true with the Fibonacci's coming from low up to high. We're kind of at that 38.2. So if if this area can resolve higher, again, it's game on, and you should be thinking about that daily uptrend remaining strong for the test of 352.75 into the end of this week. If we produce the lower high, bigger problems emerge with something that looks like this. Now, you guys know me as the permabull of YouTube, but it's really not just because I want to be bullish. If we look at the market internals, the data would suggest that even though this feels incredibly nasty in the downward direction, we still have volume inflows. We were still positive on the advanced decline line. The cumulative build on today's session across the entire Nasdaq was 574 into the close. Positive 574. Does that really feel like stronger selling at the exchange level? I have to answer that question objectively by saying no. Is there momentum that's there? Absolutely. I'm not trying to, downplay that. But at the exchange level, if we see any reprieve in these heavy hitters out here, you better bet that there's going to be some sort of, or at least I'm going to bet, that there's going to be some sort of reversal off of this known area of support for some kind of daily higher low. If the market breaks and puts in a lower high underneath, again, thin structure back here, it's totally playable in the downward direction, but I'm not seeing the overwhelming evidence that would suggest just yet that we want to just be shorting this on the first go through with the internals in the manner that they are. If we take a look at the market profile, again, there's reason to believe that we see downside continuation. Value is lower, point of control is lower. This area is still your key, 14,250 in your NQ. And that, again, is your poor low and mechanical level across the equal ones there. That unlocks the thin structure. IWM, Russell 2000, and the small caps, man, do we have an impressive move on our hands. We know that we're not too fond of actually trading the IWM, but as an overall indication for markets, this speaks to the broadening nature of the rally. Remember that we saw the improvements in the SPX A50R. The RSP is improving. Those things are moving in the right direction. The IWM falls into that category as well. Now, into the remainder of this week, we are coming in for a full double of the daily range. We are testing the top of the banking crisis candle high. Is it reasonable that we see some pullback here? We're outside of the upper edge of the weekly expected move. Is it reasonable that we see some pullback? Absolutely. Does that support the idea that the SPY could break the bottom of its balance range? Absolutely. But the key question remains, does it mean that the daily trend is in jeopardy of changing if we're just getting a mild pullback in the IWM? Probably not, right? So speaking to the broad nature of the rally, this is a really bullish data point in my estimation. The more time we can spend over 179, the more constructive this is in the upward direction. Now, we do have single prints to contend with. If we move on down to the hourly time frame chart, you can see that it was a squeeze on Tuesday and then mild consolidation into the close. And on today's session, things are definitely slowing down. So if we do start to pull back, your breakdown is literally underneath the upper edge of the weekly expected move at 186, brings you back down to the sort of beginning of singles. That's 183.50, and underneath that, that's where deeper pullbacks can unfold. A line in the sand for the IWM. Sure, you could use 179, but more constructive would be 180.50, right? 180.50 represents technically the neckline of this double bottom. Being above that would speak to the buyers remaining in control and the broad-based nature of this rally continuing to stay in effect instead of deteriorating and proving to be a false signal. Apple is up first for our core list of companies, and the bears are building an edge on this chart here. You can clearly see in the upper wick of today's session, there's a complete lack of acceptance over the hammer high from Tuesday, and we close weak at the bottom of the trading range. So an equal low breakdown through 176.75, the low of today's session as well, should usher in the gap close to 175.75, and a deeper pullback than that brings you to 174. Now, when and if we get to 174, I would certainly keep an open mind for a higher low to develop on the daily time frame chart, considering that we are in a very strong daily uptrend, and we're also pulling back off of a brand new all-time high. Now, for upside, if we're consolidating, here's the hourly time frame chart. We can, sure, you've got your head and shoulders. We just talked about downside outcomes, but from a more nuanced perspective, right? If we're just chopping around in here, it's exactly that. It's chop. I would not trust longs in Apple if we're consolidating until we can produce a higher low back above 179.50 based on the failed upper wick from that first hourly bar right here. Same concept will really apply to Netflix, so we're just going to keep it on the hourly chart for now. Here's a multi-bar range. There's your upper wick failure, and we find ourselves at the bottom end of the range. So the bears are clearly building an edge. If we flush the lows, you're looking at 390.50. Beyond that, the better range to be trading for in the downward direction is here, down towards 374.50. Just like in the Apple chart, we really won't trust it for buy side until we can produce a higher low above 410.50. If you can get it close enough down here with tight risk reward, like we're dealing with, I don't know, a 2-to-1, 3-to-1, whatever, for that type of rotation in the range, that's fine. But just make sure you're not looking for arbitrary longs in the midpoint, expecting some kind of breakout. That's the main point with Netflix. Let's take a look at Tesla. Tesla's kind of in no man's land, considering the move higher has been nearly vertical. It doesn't make sense to be risking new money longs up here, and there's also no real attempt, or there shouldn't be an attempt to try to short this. It's just too strong. There's no structure here. There's unfortunately no structure here. So on the hourly time frame chart, we can start to understand that, like, sure, if we break down under here, we should technically look for 216.65, but the better trades will really unfold if this is going to put in a top once we breach some of this, and then we can look for the lower highs against structure here, or we could look for the lower highs against structure here, right? So we don't really have anything clear cut in Tesla. So this is probably a patience play into the remainder of this week. Google is up next, complete round trip on this move out of the balance range. I thought Friday really set up the move for Monday to be the break to the bottom end of the range, but unfortunately the timing was just totally wrong on that on my part. So by no means did I catch any of this downdraft out of Google, but we do find ourselves at the intended target 122.15 because we have round trip, because we have 100% retracement. The excuse is to look for a lower high. It's very difficult for markets to get straight up continuation after a 100% retracement, especially in one day, right? So lower high, digest the move. If we get an equal low, that's where the door really opens up for some of these downside outcomes. You've got 120.15 and then also 117.50. Just like everything else, buyers only have something going on if we can prove it with a higher low above the top of range at 124.75. Metaverse, what's going on with Zuckerberg's Fantasyland breaking this balance range? So this is really what we're looking for out of something like Netflix, right? Netflix is still in the range. In here, this is kind of what we want to see, that bigger downdraft, that deeper pullback unfold. Now, in Meta, I would be looking for lower highs underneath 265.85 because in theory on the daily time frame chart, that was your ideal pullback. That was your ideal higher low pullback. Obviously, we've produced a solid red-bodied bar. There was no stopping there intraday, right? We went right through that level, hot knife through butter. So lower highs underneath continue to be tradable in the downward direction, and I would just look for the next support zone, which is technically down here at 255.27. The issue with that kind of pullback is that obviously it produces a lower low from here to here, and then any sort of lower highs produce now a big daily head and shoulders, right? That is a stronger indication of a reversal there, just trend reversal and trend count type stuff. Upside gets difficult. Wouldn't really trust upside here until we can produce higher lows back above 270.50, right? That would, of course, look something like this. That's a really bad illustration, something like this, right? Really got to retrace this downdraft. I'm really not even comfortable doing that because the setup is short here on a reattempt at the overhead supply. So 270.50 is your key upside level to be monitoring for, not in love with Meta upside. Could we get a rebound tomorrow? Sure, you could get an oversold rally, but in terms of structure to play against, it's not really there. NVIDIA, what do we see? Certainly starting to produce head and shoulders, right? Again, that's kind of the theme of these charts that we're looking at here. We are underneath the neckline there at 379. So as long as this continues, we're starting to usher our way into the gap beneath us. That's no man's land, right? This stock has been in no man's land. I'm not really convinced, like, better structure to trade against. Yeah, it's getting better as more time elapses, but even still, right, the best thing I would say for right now is just, looking for this is your best outcome. That way you've got tight risk with a stop just above. Don't forget that the gap for the most part is still holding up here. This is still bullish context, even though we're starting to show that head and shoulders pattern. Next up is Microsoft. Big reversal, just like we saw on Google and even Meta. This is also not really close to any relevant levels. Notice how it's a 100% retracement and some. So shorts, I mean, yeah, if you want to play for a very small amount of range into 320, where is there a level to set a lower high other than where we broke down from, which was up here, the opening print 331? It's just like there's nothing major to be queuing off of in this Microsoft chart. So this is kind of a patience play. I would wait for intraday structure to unfold only. If you want to get nuanced and start breaking out Fibonacci's, I mean, you can do this type of thing, but it's not nearly as structurally relevant as literally having a level there, right? So in theory, bears really remain in control underneath 327, just based on a rough fib perspective. Last but not least, we've got the mini beast. What's going on here with Amazon? Same idea as everything else, strong breakdown, but there is better structure to be trading off of. Notice that with Amazon, right? So if this does support and we find some rotations higher tomorrow, I wouldn't necessarily long that. I would look for the lower high opportunity up against 123.25 for a short. Then you look for the equal low break and you just keep walking these targets down, right? So that's the downside here for a further pullback out of Amazon. Buyers will have something going on if we can get that higher low back above 123.25. So this one is definitely tradable based on the structure. 123.25 is the key level that I would carry forward. 4 trade ideas for you, and then you're on your way. AMZN is making a guest appearance tonight for a short setup to rotate through the gap, which of course was a result of the NVIDIA earnings. Notice that we have a bullish engulfing bar followed by a bearish engulfing bar. So after exceeding this prior high, again, let's go back. So we were just on a daily. Now we're going back down to the hourly. We're jumping all over the place with time frames, but you get the idea, right? This was a failed move above the top of this as consolidation. We were trying to build out a new uptrend with a set of higher highs. It did not happen. So going forward, just like everything everything else, we can't break our rules. We do have a 100% retracement. We're looking for any lower highs intraday, and then a flush of this should start to close that gap. Right from here, lower high, looking for another lower high, ideally underneath 120.70 sets up the short in AMD for rotation through the gap below 115.90. Next up on the docket is going to be BSX for Boston Scientific. And Boston Scientific, let's go back to a daily time frame chart, is just setting up a very classic H pattern here. If we can flush those lows at 50.39, looking for continued downside. The options chain is not ideal, but I do believe that Thinkorswim has shares to borrow for shorts on BSX. This is also available as like a head and shoulders type pattern, right? Flushing this neckline. It's the same idea. What should the target be? Perhaps a little bit lofty as a day trade, of course, but 48.85 seems reasonable on the pullback based on that being the breakout point from in the past. The reason I like this is because if we look at it as sort of, different time frames, we've already seen the 100% retracement. Today was the lower high inside bar. If we flush that inside bar low, that sets up the daily pattern, right? If we just go back to the daily, there's your nice little inside bar setting up technically a 3-bar play in the downward direction. So BSX, even if you don't trade it, just watch that setup so you can learn how that sort of unfolds in the future. TGT is up next for good old Target. And this we're looking for a little bit of an oversold bounce from. Obviously, it got absolutely hammered on that move lower in here. It is starting to build a little bit of a base. If we go to an hourly time frame chart, you've got something emerging as an ascending triangle. Nonetheless, if shorts are positioned here with bad location and we can clear this top, just looking for a minor move in the upward direction here towards the breakdown point in the open of this bar at 138.32. We are not overstaying our welcome on the long side. The trend is clearly down. There's clearly a momentum here, but it wouldn't be unreasonable to look for that type of thing into the future here. So that is a scalp only. I would not recommend or suggest that you do any type of swing, especially with options bottom fishing out of target. Last but certainly not least is a trade to only consider with shares. That's going to be on PENN National Gaming, and that's just simply because the options chain is brutal. There's not really enough liquidity there. The spreads are really wide. I wouldn't recommend it, but nonetheless, you can see that we are coming in for a very ugly, I wouldn't really classify it as an inverted head and shoulders, but the point still stands that we have lows, higher lows, and if we can crack this is really thin structure from the earnings gap and go, right? So if we look at the hourly time frame chart, there's nothing there. There's nothing there. If we can crack this high, which is exactly where we pressed into today, 26.88, we're looking for upside into 28.35. Another reason not to use options on this is just because the price point is so cheap. You're hardly moving one delta. I totally get it. You can size up because the options are cheap, but there's not enough liquidity on the chain. So I'd really recommend that if you're interested in this setup, probably use shares, all right? That's going to wrap up today's episode of the Midweek Market Update. I had to do the later segment a bit later, frankly, so I do appreciate you tuning in. If you're tuning in on a Wednesday night, let me know with that keyword down below in the comments section. I will see you all tomorrow morning, bright and early, for our pre-market prep. With that said, I wish you a green trading week.